Good morning, everyone. Thank you for joining us in our mortgage seminar this morning. Again, my name is Brian Fryer. I'm the sales manager with TVFCU in the real estate department. This morning we're going to be talking about refinances and HELOCs. HELOCs, also known as home equity lines of credit. So got a lot of information to cover today, so just please bear with me. We have a few questions we're going to be going over, but basically just want to start off talking about a refinance. What is a refinance? Refinances come in different forms. Basically, if you have a current mortgage on your existing home that you live in, you can refinance that home either by trying to get a better rate, a lower interest rate, or a better term, a lower term. Let's say you purchased your home and you financed it on a 30-year fixed rate, and you're a couple of years into that mortgage and making a little bit more money in your career, and rates are a little bit lower. You can look into refinancing either to get a lower interest rate, or you can refinance it to get a shorter term, or both. I'm one of those. I'm a big fan of doing a shorter term mortgage if you can. I know it's not always possible when you first purchase your home, but trying to cut down on that term and pay that home off quicker is always an advantage. You do save a lot of money in terms of interest too. Another type of refinance is what we call in the business a cash out refinance. That is getting equity out of your home. Basically, if you've been in your home for a little while or you put a large down payment on it, you do have equity in the home, or the home is gained in value in the short term. You have equity in that home that generally you can tap into and pull any cash out that you might want to use for any home improvements, paying off any existing debt, maybe a large purchase, or maybe taking some money out to pay for school or something like that. That's known as a cash out refinance. So both of these are what we call a first mortgage. And also too, going back to the refinance as far as getting a lower interest rate, one of the questions we had was how much lower rate do I need on a mortgage to justify refinancing your home? Well, it's always been said for years that you want to see if you can get 2% lower than you currently have. That's kind of a rule of thumb. It's not exactly written in stone. Like I said earlier, you maybe want to looking at taking your term from a 30-year to a 20-year or a 15-year or even a 10-year. It's going to depend on what you can currently afford, and also to how much lower you can get that interest rate. I will say this too, as far as interest rates go, on any mortgage, the shorter the term, generally the lower the interest rate is going to be. Your higher interest rates are going to be on your longer term. Also too, whenever you're looking at it too, if you're going to be going to a shorter term but a lower interest rate, sometimes your payment still will probably be a little bit higher, so you may not be going down as far as payment wise, but you will be cutting that term down and paying off your home quicker. I'm a big fan of that. I'm just going to be honest with you, especially nowadays with the rates being at historical lows. A lot of times we found people that finance their home on a 30 or 20 year, say 3 or 4 years ago, they're looking at refinancing now, possibly to a 15 or a 10 year. The rate is substantially lower. Their payment might be the same or higher than it was on their 30 year because they're at a shorter term. But if you look at the amortization and the interest that you pay back over a time period, it's much less. You're going to be saving a lot of money in the long term. Plus, also too, you'll be paying off that home much quicker. And that's everyone's goal. You want to pay off your home, definitely by the time you retire. That's everyone's goal. But also too, when you purchase your home, you may have children. You're looking at sending them off to college in a few years. You may want to try to have that home paid off by the time they start college, just because that's one of your largest debts that you will no longer have to be paying. And it frees up money for that college or for hopefully that retirement that you'll be retiring. So that's the ultimate goal. You want to try to pay off that home as quickly as possible, and then take those additional funds you were paying towards that mortgage and put that into any type of college or towards retirement, or just basically enjoying life. So again, cash out refinance, rate term refinance, two different types of refinances on a first mortgage. Back to the cash out too. Basically, when you look, hey, I'm thinking about taking some equity out of my home. My home is estimated value of, let's say, $300,000, and I currently owe $150,000. Based on the type of loan program that you qualify for, you can take out a percentage of the equity in that home. So you'll want to talk to a TVFCU mortgage originator basically to see what might be the best type of program for you, payments and rates. We can run an amortization schedule for you too. Also to see how much money you're going to need and how much you would qualify for based on estimated value. Now, I might want to mention also too, whenever doing refinances, whether it's a cash out refinance, rate term refinance, generally it's going to require an appraisal. Appraisals are done by third-party companies that we at TVFCU order through. Also through, if you're using a different lender, they're going to order an appraisal in most cases. Some cases it doesn't require appraisal, but most cases it is on refinances. Those independent third-party appraisers, they are going to be using market data based on recent sales of your home. That home is going to be similar to the construction, the age, size, area, and it needs to be a recent sale too in order to use those comparables for the value of the home. So that is very important. Kind of want to have an idea before you even start looking at this, what you think, what your home is worth. Looking at other homes in your area that have actually sold and that are similar to yours, and to kind of estimate what the home would be worth. There are websites that you can go to online to kind of give it an idea. Also, tax assessment value gives a little bit of an idea too. But mainly we do have to have an appraisal to get that actual market value, and based off that, the equity that you can tap into to refinance. Also too, want to start talking too a little bit of something that's another option you can have, also known as a equity loan or a home equity line of credit or a second mortgage. There is a little bit of difference between the two. I'm going to kind of go through those real quick. A second mortgage is going to be where you take an equity loan out in your home and you currently have a first mortgage on the home. So you're basically leaving alone your first mortgage. So let's just say you have an excellent rate on a 15-year fix or something like that on your first mortgage, but you want to take some equity out. You can take a second mortgage out of the home. Generally, those are going to be a shorter term, 15, 12, 10, 5, 7 years, something like that. Interest rates might be a little bit higher because it is a little bit of riskier loan for the lender, but it is a fixed term, it is generally a fixed rate, and it's a fixed loan amount. That loan amount doesn't change. You don't borrow any more against it. So you could take out $20,000, $30,000. With that money, you can pay off debt, you can do home improvements, you can pay towards a college fund or school funds you may want to pay. So basically that is an extra avenue without touching that first mortgage. Again, you really, if you've got a great rate on your first mortgage currently and you want to take out a second mortgage and you don't want to touch that first mortgage, then a second mortgage fix is really a good option there for you. The next item is a home equity line of credit, HELOCs. Everybody hears about HELOCs. What are HELOCs? Well, basically a HELOC can be a first or a second mortgage. If you don't have a mortgage on your home right now, you can take out a HELOC. That would be in first lien position. It is a first mortgage, but it's still a HELOC. If you have your mortgage right now, like I was talking about, if you have a really good rate and you don't want to touch that loan right now, but you do want to tap into some equity in the home, you can take out a second mortgage, home equity line of credit. It is a second lien. Home equity line of credits, those are different from your second mortgages because it is a line of credit tied to your home. So basically it's an open line of credit. Let's say you have about $30,000 in equity and you take out a $30,000 home equity line of credit. You have that line of credit that is available if you need it. You don't have to take out the full $30,000 at this time if you don't want to. In these loans, and it depends on the lender you go through. If you go through TVFCU, it's a 20-year loan that you can access the equity in your home. If you don't need the money, you don't pay any interest, you have no balance. If you have no balance, you pay no interest, no monthly fees with TVFCU. So it is a great avenue if you know that you might be doing some home improvements in the future, or you might have some upcoming bills or something like that, or something you want to pay on, college or something like coming up in the next 2 or 3 years. Go ahead and taking out a home equity line of credit can be a great avenue. I do generally, when it comes to home improvements, if you're not going to be cash out refinancing your first mortgage and you're looking at the difference between a second mortgage or a home equity line of credit, Generally, a home equity line of credit sometimes can be the best option. And the reason I say that is you may have a contractor you're working with, and let's say they say, to remodel your kitchen, it's going to be $30,000. I always tell everyone, when you're looking at remodeling, you may want to plan on looking at trying to get a little more money or have access to more money than you plan on. Just because sometimes whenever they go in and start doing the remodeling, there are unknowns that you don't know about at times. And my personal opinion, I think it's a good idea to have a little extra available if you need it. Just because you don't know what you're going to run into. You start knocking out walls, knocking out cabinets, flooring. There may be some issues, old wiring, plumbing, that's going to run a little bit more expensive than initially thought. And you don't want to be caught in where you're short on money for a project, and you want to make sure that you still have those available funds. They're there if you need them. If you don't take them, then you're good to go. But it is available if you do need it. So the home equity line of credit is, to me, is an excellent avenue for something like that, especially for the home improvements, if you want to do those. They also work a little bit different with home equity line of credit. Generally, most lenders, it is going to be an interest rate that is tied to prime lending rate. Here at TVFCU, ours are. And based on your credit score, it's going to be the current prime interest rate with or without a margin, depending on your credit. So what that means is currently prime is set at 3.25%. Those rates are going to be adjustable based on the prime lending rate. So it can rise, it can fall. So just be aware of that. If you're talking to a lender that offers a home equity line of credit, you want to find out what type of interest rate that is, what it's tied to, and if it does adjust. Okay. So that's something just to be cognizant of and aware of. You want to make sure. Also, with the home equity lines of credit, just to let everyone know, it is an open line of credit, like I said. It is available when you need it. If you don't have a balance on it, you don't pay any interest on it. So let's say you have a $50,000 line of credit, you have no balance on it, you pay no interest on it. So you have a project coming up and you've already talked to your contractor and you're going to be doing a $20,000 remodel on, let's say, a kitchen. So you tap into those funds from your home equity line of credit and use those for that remodel. Now, your interest you're going to be paying is going to be based on the current balance. So let's just say the remodel doesn't cost as much as you thought it would be, $30,000. Let's say it's only going to cost $14,000. So you go in, they start doing the work, they run into an issue, and it's not going to be, or it's going to be more than you planned on. You can tap into those funds as you go if you need it. Okay, just an FYI. On most of these loan products, or the home equity line of credit, sometimes those payments are set up as an interest only or a minimum payment due each month. You can generally pay extra towards a principal to pay that off early. I do recommend doing that. You don't want to carry that interest for a long period of time. Shorter period of time, you pay less interest, you pay less money. It's more of a savings for you. So also want to go back to the second mortgage fixed. A program like that is going to be generally on a fixed rate for a fixed term and a fixed loan amount. Let's say you have a debt you want to pay off. Let's say you have an auto loan that has a high interest rate and you want to pay off that loan. You can tap into the equity home using the second mortgage or the home equity line of credit, or you can even opt for the first mortgage cash out refinance to do that. Some people say, well, what is the advantage of that? Well, lower interest rate. You can lower your monthly outgo. Let's say you currently have a mortgage payment of $1,000 a month, and your car payment is $400 a month. Rolling that debt in to the equity in your home, you can bring your monthly outgo down to a substantial amount sometimes. That is, something you may want to look at. If you're currently struggling with your bills, and if you could lower that monthly outgo, that might be a good option for you. Also, too, in some cases, that interest that you carry with the mortgage is tax deductible in some cases. So just want to be aware of that. You want to talk to your tax professional to make sure that you qualify for something like that. Got a couple more questions here. One of the questions was asked about maximum amounts on home equity lines of credit. It's going to depend on your lender. Each lender can be different. Also, what we call the loan to values will be based on your credit and the type of property, etc. In some instances, you can borrow the full equity in the property. Some instances, some lenders do limit you on how much you can borrow. Generally, on first mortgages, if you're going to be doing a cash out refinance, some lenders will maximum amount will be 80% of the appraised value. Some lenders up to 90%. The second mortgage is a home equity lines of credit. You can take the full equity out of the home. So you want to check with your lender, and again, I really would like you to call TVFCU and talk to us and see what we can do for you. We do have some great products. We do actually on some of our products, you can pull the full equity out of the home. So do be aware of that and check with your lender. Next question we have here, I'm interested in refinancing. What do I do and how do I start on the process? Well, let's just circle back around as far as the process goes. It's going to be similar to when you'll be purchasing a home. You'll want to look at your budget. You'll want to see if there are any debts you want to pay off, or if you have the upcoming project, or if you have any student loans or any student fees you'll want to be paying for any children, college, private school, anything like that. You want to look at your budget and see what your goals are going to be here in the next year, 2 years, 5 years. I always tell people, sit down, look and see what you're paying out right now, look and see what you can afford. You want to do a little research and see what your home might be valued at, to see if you do have any equity in the home. Currently, you may not be in a situation where you have much equity, and you'll need to maybe try to pay a little bit more down on the home and see if you can gain a little bit more equity in the home before you can take out any cash. So definitely budgeting, looking at your current situation, doing a little bit of planning and see where you want to be. Also too, in regards to doing home improvements, this is asked quite a bit. People have asked, Brian, I'm looking at remodeling my kitchen and it's going to cost $10,000, $20,000, $30,000. That's going to bring my house up in value. It can bring the home up in value. I will say though, a lot of times it's not a dollar for dollar kind of thing. There are some things you can do to your home that will add value pretty quickly, as far as like adding square footage, etc. But dollar for dollar, a lot of times you're not going to get the value come back as you would, like say, adding square footage or something like that. So just be aware of that too. Again, I'm not saying not do any home improvements. This is your home, so it's your biggest investment in your life. You do want to do improvements to maximize that value in the home. Plus, it's a place where you live, and you want to live in a home. If you're going to be paying for it, biggest investment in your life, you want to live in a home that you can enjoy and feel comfortable with. So again, budgeting, making a plan, those are all very, very important. As far as the process, once you've figured out what you're wanting to do, you'll want to contact a lender, let them know, just basically let them know your plans and your goals and what you're wanting to do. Once you're talking to that originator or loan officer specialist, they then can go and look and see what might fit the best programs for you, whether it be a cash out refinance, rate term refinance, a fixed rate second mortgage, or a home equity line of credit, and give you your different options. Again, I'm a big fan of all these products. It depends on what your situation is, but you'll definitely want to talk to someone, a mortgage professional, who can lay out those options for you. I always tell everyone, I like a plan A and a plan B. If my home is worth this is how much I owe, this is what I'm wanting to do. This is what I'd like to do as my first plan. If the appraisal, let's say the appraisal doesn't come back as much, what is my plan B? I always like to have a plan A, plan B, just in case. Home values in the Chattanooga area across the United States have been going up. So, but it's going to depend on what the appraisal is going to come back at. So that's one thing just to be very aware of. It's going to depend on what the home appraises for. Also, too, looking at the type of home, whether it's a single-family home or if you have a manufactured home, condominium, townhome, duplex. There are different types of homes, and there's different options for you too there. So you'll want to let your lender know, what type of home you have. Also, too, whenever you're doing your budgeting and you're getting your information together, you'll want to find out if you have a current mortgage on it right now, what is the term you're on right now? How long have you been paying on that mortgage loan? Also, what your current interest rate is. So you want to know all that information too. That way you can see and let your lender know, this is what I'm currently paying right now. This is my interest rate. This is my term. This is what I'm wanting. I'm wanting a lower payment. I'm wanting to shorten my term. I'm wanting to do both. I'm wanting to take out some equity and get a lower payment and lower term if I can. So there are lots of options out there for refinancing. There are a lot of tools online that you can use. But I do recommend talking to a mortgage lender and getting all the information to them so they can lay out all the options that you have. Now, getting to the process, once you've gotten all of this information together, you've talked to your mortgage lender, and you want to proceed. You found the term that you like, the rate that you like, everything looks great. You want to go ahead and be getting together your paperwork. In mortgage lending, of course, everyone knows we are going to need some paperwork to process your loan. Generally, that's going to be any type of income documents. If you have W-2s, last 2 years W-2s, 30 days worth of pay stubs, tax returns if you are self-employed or if you have any type of investment property, any type of retirement funds, verifications, Social Security, awards letters, etc. We will need that documentation. Also, what's different in the refinances from when you're purchasing a home, you already own the home. We are going to need a mortgage statement, the most recent mortgage statement, homeowner's insurance declarations page, and any other homes that you own, investment property. We're going to need mortgage statements on those, and also homeowners insurance information, tax information, etc. So there is documentation involved. The reason we have to have this documentation is because we have to show what payments are, what taxes are, what your homeowner's insurance is, in addition to verifying your income, etc. So that's something you want to be gathering up and getting ready for your lender, because it is going to be a requirement of the loan. In some cases, you may not have that documentation. If you can get something from your insurance company, the declarations page, or at least let your lender know who your insurance company is and contact information so we can get it for you, okay? Basically, if you can get it ahead of time, that's always best. And that information will be the most recent too that we'll need, in addition to bank statements, etc. If it's not with currently your lender. You want to make sure all that documentation is up to date and the most recent too, because that documentation can expire. Your lender, if you have, let's just say, a mortgage statement from 6 months ago, they're going to need something that's recent. So just be aware of that. All this documentation does need to be recent, okay? Once you get all that together, your lender is going to be having you sign some initial disclosures or documents, locking your rate, very, very important. I always tell everybody, if you are looking at refinancing and rates are low, you'll need to make a decision where you want to lock that rate in or not, or float it. Again, that is something that you're going to have to make a decision on, talking to your lender, what your best options are for that. Because if you do not lock, you could miss out on that low interest rate, because rates can change on a daily basis, sometimes can change multiple times a day. So just be aware of that. If you're talking to your lender, you like that interest rate, you want to go ahead and get started, lock that rate in as soon as possible. So make sure you get that rate, okay? Once you've signed your disclosures, you've signed your documentation, you've locked your rate, you've given your documents to your lender there is going to take that, your originator is going to take that and turn that over to a loan processor, who is going to order the title work, which means a local title company that's going to do a title search, make sure no liens and encumbrances on the property other than what's already known, and they will be handling the closing too as well. And also too, we'll be ordering appraisal. In most cases, some cases do not have to. It's going to depend on your loan program and what you qualify for. These are independent companies that we use locally, and most lenders do the same. And these appraisers will contact you and set up a time to look at the home if it is an interior inspection. In some cases, they'll only do an exterior inspection if an appraisal is done. So just be aware of that. That's something too you want to talk to your loan officer about and get that information. Once we get that information back, also your processor is going to verify the employment or verify the income, and we get most of that information back. That's going to be given to our underwriter, and your underwriter is going to go through everything, make sure everything matches the type of loan program that you're in, and they will sign off on it if everything is good to go and your loan is clear to close. You'll be set up to do a closing. Generally, most closings are going to take place at a local title company. With COVID-19, most of the title companies that I'm aware of in this area are taking precautions as far as social distancing, wearing masks, making sure everyone's safe at their closing. In refinances, generally, once you close, there is a 3-day waiting period before that loan goes into effect and before any funds are distributed by the title company. So just be aware of that. On refinances, on your primary residence, there is a 3-day waiting period after closing that is called a 3-day right of rescission. And people ask, well, why do they make you do that? Well, that is a federal law. If you're refinancing your primary home, you're given 3 days to look over your paperwork to make sure that's the loan that you want to do. You have, within 3 days after closing, you have a right to rescind on that loan at no cost to you. So just be aware of that. Your lender is held to that, and you do have to go through that 3-day rescission period. There are some exceptions, but those are extremely rare, very, very rare. But do be aware, if you're counting on getting funds for a project after closing, you still have to wait 3 days until that loan goes into effect and before any funds are started to be distributed. So just please be aware of that, especially too also if you're looking at paying off a debt or something like that. You'll want to make sure that the lender that you're paying off, that they are going to be receiving their payoff within that certain time period. So just please be aware of that too. A lot of people don't realize that when it comes to refinances, that there is that 3-day rescission, and it can cause some problems if you don't plan for it. So just please do plan for that. And then lastly, once you've done your loan and everything like that, you'll have a new payment, new setup on your mortgage and everything like that. So refinancing to me is a great option, especially nowadays when the rates are so low. In my 23-year career, I've seen rates be as high as 7, 8, 9, 10%. Right now, rates we're looking as low as 2.25% on 15-year loans. So just please be aware of that. That right now is a great time to refinance, whether you're going to be doing a lower interest rate, a shorter term, or you're taking some equity out in the home, either a cash out refinance, a second mortgage, or a home equity line of credit. Rates are great nowadays. So please be aware of that. And if you're thinking about doing it, do a little bit of homework and talk to a mortgage lender. Preferably, we hope you talk to TVFCU. We're here to answer any questions that you have. And if anyone has any questions about our seminar today, please let us know. Be happy to answer any. And again, thank you for being with us. We really appreciate it. Again, if you need to contact us, you can reach us at tvfcu.com or call us at 423-634-3667. Thank you.